A major banking regulation has just been finalized, and it officially goes into effect this week. And while it hasn't made massive headlines yet, it could directly affect how you access your own money. For millions of Americans, this update may change how banks review deposits, monitor transactions, and in certain cases, how quickly they can restrict or freeze funds inside an account. Most people won't even know this rule exists until something suddenly stops working. An ATM refuses to dispense cash, a debit card transaction gets declined, or an online payment fails without explanation. But because you're learning about it now, you have time to prepare before it impacts you. This regulation comes from the Financial Crimes Enforcement Network, commonly known as FinCEN, which operates under the U.S. Treasury Department. The rule is an update to what's called the Customer Due Diligence requirements, specifically the beneficial ownership reporting standards. In simple language, banks are now required to gather and verify more detailed information about who owns or controls certain accounts. The official purpose behind this is to fight money laundering, financial fraud, and terrorist financing. Those are serious and legitimate issues. However, the way banks apply these stricter verification rules can create unintended consequences for everyday account holders. When monitoring systems become stricter, the chances of legitimate activity being flagged also increase. Banks are expanding their compliance systems, and that means more transactions may be automatically reviewed, even when nothing improper has occurred. If your account is flagged, access to funds can be temporarily restricted while documentation is reviewed. Even if everything is resolved, internal review records may remain on your profile. One review might not cause problems, but repeated flags, even innocent ones, can result in your account being classified as higher risk. That classification can affect your ability to open new accounts or maintain existing banking relationships. Let's look at a real-world example. Michael is 54 years old. He owns a small landscaping company and has banked with the same institution for nearly 2 decades. Recently, he deposited a $6,000 check from a regular commercial client, something he had done many times before. This time, however, the deposit was placed on hold for a compliance review. He was asked to provide updated identification, documentation proving business ownership, and verification of the source of the funds. For 5 days, his business account was inaccessible. Payroll was approaching, equipment payments were due. By the time the situation was resolved, he had accumulated around $400 in fees and emergency cash adjustments, not counting the stress and lost time. Here are the 5 key changes you need to understand. First, expanded ownership verification. Banks must confirm the identity of anyone who owns 25% or more of a business account, or anyone who has significant control over it. Even freelancers, side gig workers, or individuals receiving business income into personal accounts may be required to submit additional documentation. If documents are not provided or inconsistencies appear, accounts may be restricted until verification is complete. Second, tighter transaction monitoring. If your account activity suddenly changes, such as depositing money from selling a vehicle, receiving a large bonus, or getting family financial support, that deviation could trigger a review. Third, more scrutiny on international transfers. Cross-border transactions now require more detailed explanations, and processing times may increase. Fourth, compliance-related fees. Failure to respond to documentation requests within the deadline could result in monthly fees between $25 and $75 until resolved. Fifth, slower activation for new accounts and large transactions. New accounts may require 3 to 7 business days for full access, and large, unusual transfers may be temporarily delayed. Now compare Michael's experience with another business owner named Dennis. Dennis heard about the rule changes early. He contacted his bank, updated his documentation, confirmed his contact information, and notified them of upcoming large deposits. When a significant payment arrived, it processed without interruption. The difference wasn't luck. It was preparation. Here are the steps you can take immediately. Log into your online banking and confirm your address, phone number, and email are accurate. Keep digital and physical copies of identification and income documentation. Maintain records for larger deposits, including receipts or invoices. Notify your bank before making unusually large transactions. Enable account alerts so you're notified instantly if something changes. And consider maintaining accounts at more than one institution for backup access. Whenever new regulations are introduced, scammers attempt to take advantage of confusion. Remember, your bank will never call and ask for your PIN, password, or full account number. They will never demand that you move money into a so-called safe account. They will never threaten immediate closure without proper formal communication. If you receive suspicious messages, contact your bank directly using the number on the back of your card. This regulation is real, it is active, and it changes how banks monitor accounts. Being flagged does not mean wrongdoing. It means being prepared with documentation and responding quickly. The difference between inconvenience and major disruption often comes down to awareness. Stay informed, stay organized, and stay proactive.